This one's a very interesting session. I'm sure in bits and pieces you've heard quite a lot about, from a lot of speakers, that IFRS 17 is something which is now getting into impacting the Indian insurance industry. There's a lot of, it's quite a hot topic these days. So it'll be very interesting to hear from our panelists, and it's quite a, distributed panel. You have a regulator, you have a global perspective, and you have a consultant's view also to gather here from. All right, welcoming on the topic IFRS 17's key developments and challenges, I'll welcome the panel on stage, Mr. Cheong, also popularly known as Tony, Director of Strategic Initiatives, AIA Group, Singapore. Ms. Mamta Suri, Executive Director, Insurance Regulatory and Development Authority of India. Mr. Kunj Behari Maheshwari, Partner and Head of Life Insurance Consulting for India and Sri Lanka, Willis Towers Watson, Actuarial Advisory, LLP. Mr. Philip Jackson, Principal and Consulting Actuary, Milliman, India. And the last panelist, but not the least, Mr. Kailash Mittal, Partner, KPMG, India. And to chair this session, may I please invite Mr. Satyan Jambunathan, Chief Financial Officer, ICICI Prudential Life Insurance Company Limited. Over to you, Satyan.
Thank you. Good afternoon. At least to me, this topic of IFRS has had a very, very long history. Multiple false starts, multiple implementation timelines. But we now seem to be at a juncture where at least globally we are into implementation. We've already started seeing a number of companies putting out preliminary results. And over the course of this calendar year, I expect we will see many more detailed financial statements on an IFRS 17, IFRS 9 basis being published across the globe. So in that context, it's quite important for us as a market, as an industry, to take stock of where we are, understand what our current options and what the roadmap is likely to be, and start preparing so that when we have to get there, we have a fair sense of what the roadmap is all about. So it is in this context that I have the privilege of being joined by very diverse and eminent people from across the insurance stakeholder groups. I want to do this more as a question and answer, conversational, some with the panelists and some with the audience as well. Feel free to raise whatever questions are there on your mind, and we will try to address whatever we can of it. We really don't want to keep it at a very high theoretical level. We want to keep it a little bit more relatable, a little bit more practical, so that you have a sense of what could be in store over the next few quarters as India goes on its own journey of IFRS implementation. So with that in mind, I wanted to start off in setting the context and asking Dr. Mamta Suri, we have now had a period of time where the regulator set up a specific mission mode team for IFRS 17. And a lot of work has been happening over the past few months. I wanted to take the advantage of your presence here to share with the audience as to what developments have happened and what do you see as the implementation time frame or plan.
Thank you, Satyan. A lot of people I met on the sidelines and everybody is on. So what is the date that is going to be announced for the implementation of the INDAS? Of course, a lot of our friends here have been interacting with us over the last 6 to 8 months, and they are aware about what the developments have been. So as Satyan mentioned, we have set up a mission mode team on the implementation of the IFRS. And we've been pursuing with the industry as regards what they ought to be doing to ensure that the implementation happens in a smooth manner. The intent is that we've given a kind of a roadmap or a glide path, what we've referred to, over which the companies would scale up their implementation of the INDAS. We didn't want it to be kind of a timeline announced in terms of this is the day effective which it will be implemented. Rather, we wanted to hold hands of the industry and slowly take them up on the glide path. So the intent is beginning March, ending this year, slowly with maybe a 10% implementation, they scale up to a 100% financial statement, including the disclosures, which happens by the end of January 2025. That is the intent. And we've also been, in a way, holding hands of the industry, saying that they need to scale up in terms of their actuaries, their accountants, the IT platform, what they ought to be doing. We also have put in place what we refer to as the expert committee. And a number of my colleagues here on the panel are part of that committee as well. Both within the jurisdiction as well as internationally, we are taking help of various people, learning from their experiences, and seeing that the glide path is as smooth as possible. We've also set up a platform for discussion where the industry, if they have any issues, individual companies have any issues as regards the interpretation, etc., our teams are available. The Institute of Actuaries, the Institute of Chartered Accountants are there to enable us to do the interpretation, along with, of course, the regulators, experienced individuals. We have actuaries on board. We have accountants within the authority as well who have the finance background. All of us are also there. So all of us are working together to see that the implementation is as smooth as possible. But again, I use this platform as well to say that please keep moving forward. That's the only way to achieve, because if we say we'll be able to achieve by Jan 25 and not do much about it and say that there's a lot of time still available, then I think we will not be able to make a success of that. Thank you, Satyan.
Ma'am, it's interesting you say that it is all about starting early for preparation, and it's not something that can be achieved at the last moment in the hope that it's still some while away. But I want to take that thought forward, go over to Kunj. Now, particularly in the current financial reporting world, we have silos. There is an actuarial reporting silo, there is an accounting silo, there is a technology silo, there are a variety of other groups also in the organization. But the construct of an implementation for IFRS 17, at least I would expect it to be dramatically different, where these silos would not exist. Wanted to get your thoughts on how do you see that emerging, and specifically within that, how do we as actuarial professionals make sure that we perform the roles that we are expected to?
Right. Thanks Satyan for the question. So IFRS 17, Satyan, is one of those really interesting programs where if you, depending on who you talk to, you get to know what kind of a program it is. So if you talk to the finance people, they'll tell you it's a finance transformation. If you talk to the actuaries, they'll tell you it's an actuarial transformation. And if you talk to the IT and data people, they'll tell you it's actually a data and IT transformation, has limited to do with finance and actuarial, but it's really the how rather than the what. You are right in terms of identifying the truth of today's insurance company operations operating in certain silos, particularly the actuarial department, which has been in a unique setup of its own for many years. There's a little story there which I would like to share. And you know, to understand how we got there, we need to understand the history and take it forward from there. Now, actuaries as a whole have been embracing technology right from the advent of technology in many ways. You know, first it was mechanical sort of large calculation engines that they would have, and even early in 1950s and 60s, you see insurance departments, actuarial departments using mainframe IBM systems to punch in and do certain mathematics there and so on and so forth. Now, at the time, the actuarial department and the IT department would have to work very close together and, you know, punch in all the data in the systems, book a time for it, and get their numbers out at whatever frequency they could. The advent of personal computers and some of the IT people becoming actuarial people meant that they created models and software that actuaries could disconnect from the IT developments in the rest of the organization and handle their IT systems on their own, which became the advent of, you know, the actuarial models and actuarial software around the 70s and the 80s, which we've been using since almost the 80s. And now the IT ecosystem has sort of gone far, far ahead from the actuarial technology that we are used to. So the IT ecosystem has moved ahead. the finance transformation that this entire program requires actuaries to go back into the larger ecosystem of an insurance company and collaborate again with the with the IT departments and so on and so forth. Now, what that means for the actuaries, one, we need to be very open about training everybody else, IT people, about what we know. We need to be open about learning ourselves, development about what they know. And equally, there need to be a lot of knowledge sharing and knowledge transfer, otherwise it won't work, just won't work. We need to hold each other's hand. We can't, the programs cannot work. IT department scope of work is this, finance department scope of work is this, and actual department scope of work is this. Everybody go away and your work streams come back. It can't work like that. It'll have to be joint teams. It'll have to be, you know, an actuary and an IT and a CA sitting together and working things out on the same table. They can't go away in their rooms and come back. So practically, that's what it means. Long term, what I think is, my hope rather for the profession, is we will have a lot of actuaries who might find interest in some of the more technical IT-oriented stuff and skills that they might learn. And we might even have a lot of IT people today who might come into the actuarial departments and say, okay, that was interesting, I want to do more of that. And the more sort of intermingling that will happen long term, I think that's where I see insurance companies, departments merging. But short term, we definitely need to have cross-functional teams. There is a history to how we got to the silo that you mentioned. And I think we need to kind of go back to the time prior to that.
Thank you. I clearly take away the message that this is going to be a period of collaboration and not working in isolation. And the emphasis on knowledge that you spoke about, which takes me to fill the next question to you. I'm sure there are a number of chief actuaries, experienced actuaries here who are wondering that if we go into whole-scale implementation, with the globe also implementing it, what will be the implications on my own people, my staffing, talent, poaching for talent? And a lot of younger people in the room would be very keen to say that if I have to pick and choose an area that I want to build a career in, is this really what is going to take me through at least for the next few years? So the entire challenge of people, not just in actuarial, but across the other areas, your thoughts, your experience on how we should be approaching it.
Yeah, thanks, Satyan, and nice to speak to you all today. I think maybe I'll probably start off on a slightly more positive note, because I think everybody in this room, and it's been a bit of a theme of this conference, talking to people, that we all understand that recruitment and retention is a challenge in general, and then we start thinking about IFRS 17 and we kind of get even more worried. I think a couple of things that if I'm sitting in 2023 that maybe I wasn't thinking in 2020 or 2019, I mean, we're into a kind of go live mode in many markets globally now. So if the wave is going to crest on IFRS 17 at some point, maybe that cresting of that wave is closer. You know, maybe some of those teams will start winding down and can start allocating resources elsewhere. I don't think just because it's 1st Jan 2023 that's happening now, but I definitely think that, you know, we can see that coming through from all of the international markets potentially, and that might free up resources for markets like ourselves, markets like Indonesia and Sri Lanka and other smaller markets. So the hope is there. I think also, you know, Indians have been a driving force behind IFRS 17, whether that's somebody sitting in Hong Kong contracting for a multinational, whether that's somebody sitting in Bangalore, you know, as part of a global delivery center. I mean, lots of the people in this room would have been on IFRS 17 projects. I mean, India has been delivering for the world because of the actuarial talent that we have. So I think those are two reasons to be positive, but absolutely agree with the question completely. I don't know that there's any easy answers here, but I think one of my key things that I would probably say to take away is that, and it's easy for me to say, but like start early and find someone. And maybe we need to redefine what that actuarial talent looks like. Is it somebody who has 2 years of IFRS 17 experience on their CV? Or is it somebody who has a good actuarial background and I can, you know, give them a chance to learn and give them a chance to grow? And is that my alternative? When I'm looking at a 2-year timeline, do I have time to wait around for that ideal CV or hope they become available from a, you know, an AIA global project, which may not happen for a while? You know, do I need to just find some people and train them? And Does that help me? I think most of the students I speak to are very enthusiastic about IFRS 17. They see it as the future. They see it as a way to build their own kind of like status in the industry and kind of giving some young person a chance to get going and learn and make mistakes, but, you know, maybe throw enough people at the job that they have a bit of space to do that. I think we'll talk about that a little bit more later, but I think, you know, getting people on that. And that has the secondary benefit of not just restricting IFRS 17 development to your kind of implementation team, and people who are in the wider ecosystem start seeing IFRS 17 numbers, so that, you know, as we're all going to be going through soon, somebody's going to be asking me, what does it mean? Why is it this way? There's somebody in the room that maybe has some idea about that because they've worked along it. So, and then obviously just leverage as much as you can. You know what I mean? We've got you've got talent at your group companies that can at least give you starting points, position papers, that call on the phone. I'm really stuck with this one issue. You know, we can leverage that. Those of you that operate joint ventures, you know, where you've got a life and a general or a life and a health, I think that also works really, really well. And obviously leverage all the technology that's been built. I think, you know, the technology that was built 2-3 years ago, you know, many of the companies in this room have improved it on behalf of their vendors. And I think now we're sitting in a slightly better place where some of those systems look a little bit more complete, a little bit more finished job, and let's leverage that. So I think, yeah, probably not going to get all the way to the answer, but hopefully a few ways to move forward.
Thanks, Phil. For somebody like me who spent a life only in life insurance, I'm more often than not blinded by what could be implications of these matters on other parts of insurance. So Kailash, question to you. What do you see as the implications of the IFRS transition for general insurance businesses?
Thanks, Satyan. So I too am a life actuary, but yeah, learning a PNC as a part of my role. I would say 3 to 4 aspects to be kept in mind. And I'll start with a statement that, look, all of us sitting in the PNC believe that it's just PAA and that's the simplest of the lot, so we really don't need to prep up. We have a good room available with us. We don't have to worry about the VFAs and the GMMs of the world. Unfortunately, life is not that simple. Reinsurance, which is something that all of us sitting in the GI, in the PNC space, leverage heavily, is something that's gonna really give us sleepless nights when we come to IFRS 17, or India's transition for that matter. The sheer manner in which contract boundaries will get discussed, talked about, what is the tenor, how am I pooling my risks, spreading over multiple contracts, including RI inwards that I'll enter into. That's one thing that all of us sitting in the PNC, in the GI space, really need to think through. Even applicable for the life industry, but yes, it's one of the problems which is relatively lesser compared to what it is for the GI side. So that's, I would say, one. Second, I would say, as a life actuary, discounting comes naturally to us. As a PNC actuary, we aren't used to discounting. We are used to the fact that, look, I will report or I will accumulate my IBNRs on a face value, and that's pretty much it. Even a motor TP claim that's payable 5 years or 8 years down the road is reserved on face value. And somewhere the actuaries, the management draw comfort that the investment earnings that I would be making along the way will kind of somewhere offset the inflation in the claims that the courts will pass and so on and so forth. But come to think of it, the moment I go down in Ind AS, discounting is something that will definitely haunt us. The third aspect, I would say, is that as an appointed actuary sitting in a PNC space in the Indian market currently, there is only one best estimate of IBNR that we are used to. There is no best estimate liability and a prudence markup on top, or an equivalent to an APS that I sit in the life insurance, right? I have a best estimate assumption, I have 10% or 20% markup, and then I come up with the prudent. Here there is only one number, and that is the liability number. You want to call it a best estimate number, you want to call it a prudent estimate, the appointed actuary signs off only that one number. Given the fact that we will now start talking about risk adjustment margins, or risk adjustment for that matter, where does one draw the line? Do you look at the 70th percentile, 75th percentile, or do you want to go all the way up to the 99.5th percentile? And and the quantum or the spectrum or where you draw the line on your distribution will actually determine what's the shape of the P&L going to look like. And I would say these are the three big challenges. The third one could get addressed once RBC comes into vogue, and if the two get timed, there would be a lot of learnings, a lot of efficiencies that one could explore between RBC and Ind AS. But yeah, till that, I think these three, if you were to ask me, would be top of mind for any PNC actuary in the room.
Thanks, Kailash. Now I would like to lean on Tony's experience on implementing it at a global scale. And I asked this question from the point of view of a CFO. I practically spend a third of my time engaging with investors and other external stakeholders. And I think that is going to be an area which is dramatically going to be impacted or has to be taken into account in the implementation thought process. Because there is a whole new framework that needs to be carried to stakeholders. There's a whole new explanation of results and explanation of movements that has to be carried forward. And it may well create a lot of short-term confusion or lack of clarity in the minds of investors. So I wanted to get Tony's thoughts on how have you and your organization been thinking about this, and what would be your lessons to us on how we should take this into account even as we start our journey, because it's a long process.
Thanks, Satyan. Actually, when I saw this question and I had a preview of these questions, I said he's dumping me in the deep end. It's a difficult question. Transition is always a very difficult question. So I took the liberty to write some notes in order to give you guys a well-rounded response to this. First of all, let me understand transition. Transition is basically how we move from the current accounting, let's call it IFRS 4 or Indian GAAP, as you have it, to the new IFRS 17 standard. What may not be so obvious is the date of transition. Because if, let's say, India decides to go down and implement on 1st of April 2025, the companies will actually do the year before as well on the new IFRS 17 basis. That's the comparative year, which means the deadline is much shorter than you think. Okay, so you have to get your systems ready to run your opening balance sheet on 1st April 2024 and roll it forward to 31st of March 2025. All right, so please be ready for this. From a financial point of view, transition has got many, many aspects. And as Satyan says, he goes around and sees investors. Obviously, he talks certain metrics, certain financial metrics where he would like to promote his company. Things like, for example, your balance sheet, your equity as at transition date. You need to see what it looks like on the IFRS 4 basis and on the IFRS 17 basis to see whether there's a huge change. And if there's a change, you better be ready to explain. Okay, I mean, I'm not entirely 100% familiar with the Indian accounting practices, but I know this was, I can safely share that for AIA, this was a very important metric. Yes, because we didn't really want to see a big write down in equity or write up in equity as a result of moving to IFRS 17. And then, of course, you have the other metrics like profits, and profits are very, very, many metrics. There could be your operating profits, which is a non-GAAP measure. There could be your total profits, net profit, which is what is shown on the face of the income statement. It could be your total comprehensive income, which includes all the noise that goes through on the other comprehensive income. So you need to choose which one you need to explain, which is important to your stakeholders. Personally, I regard transition to be a catch-all final bridge that has to be eventually crossed at some stage. It's really concerned, transition is really concerned about how your residual balance sheet is apportioned into CSM and equity. Because once you've already got the reserves from the IFRS 17, the rest is either equity or CSM. So how do you apportion it between those two buckets? But piece of advice is not to just focus on this exercise, because profits is the main reason why we are here. And you need to remember that you have made a lot of decisions before transition date itself. Before you finally press the transition button and get the numbers, you have made many, many decisions that could impact your opening balance sheet and your future profits. And those are things like contract boundaries, things are like your measurement models, things are like your how you treat your assets and liabilities together. Is it going to come through very volatile or not? So these are all things that you have made decisions before you press the final button called transition. Okay. Second piece of advice is the transition methodology itself. I'm sure you've heard of FRA, MRA, and FVA, all these acronyms. FRA is default, is what is expected by the standard. And once you have proven that you don't have the data to do FRA, you do have an open choice to do FVA, fair value, or MRA, modified retrospective. Now, these two methods have got their own merits. So I would urge the actuaries in this room to understand these two methods. It does change your profit profile depending on whether you choose MRA or FVA once you've crossed the FRA benchmark. Third piece of advice, you know the theory is fine, but make sure you do test every quarter, every half year. Make sure you rerun all your testing. I think it's okay for me to share this, that on one occasion, we saw interest rates started to fall, US interest rates started to fall very sharply. This was probably in the second half of 2021, just as we were approaching the transition date of 1st January 2022, when we had to set the opening balance sheet. So we were all scared. Say, interest rates falling, what does this mean, you know? To our surprise, something as mundane as time value of options and guarantees for par business, that blew up the whole accounts. So I said, wow, how did this happen? You know, it's a par business. Why is it affecting the shareholders' P&L, you know? So we did a lot of investigations, and we had to do a lot of things just to make sure we could manage the risks of interest rates falling further as we approach the transition date. So this is something very important we learned. Okay, in terms of investor communications, because AIA is really, we do a lot of these roadshows as well, and we need to make sure we approach this topic in a very well prepared way. For the investors or the analysts, we expect them to have a huge learning curve. And so we're going to give them a lot of training, reconciliations, and explanations. You have to reconcile, for example, IFRS 4 and to IFRS 17 in those numbers and those metrics I mentioned. You have to also reconcile your new business CSM to your VONB, value new business, if you report on a different basis. You do the same for in-force embedded values. So there are many, many different metrics that our investors are interested in. And so we have to prepare all these reconciliations. Also, we expect some people to focus on other comprehensive income. They don't like volatility through the balance sheet. So they need to see, why is IFRS 17 going to be more volatile than IFRS 4, especially in this other comprehensive income. So that's another part where we probably have to think about. Finally, the last point I'm going to make is all investors want profit growth going forward in the future. So I would urge all the actuaries in this room today to look closely at how you're going to achieve profit growth. Clearly, every tranche of new business you write will add to the profit growth. The in-force side, net or lapses, sure. But there could be some surprises. There could be a profit drag from your in-force because of the curve of your coverage units, or profit growth boost to your total profits from the curve of coverage units. So the choice of coverage units matter a lot. Again, that's a decision that you made early on in the project, but make sure you test and test and test to understand the impact it has on transition. I hope that answers your question, Satyan.
Very interesting, Tony. I think there are indeed a number of dimensions that we need to be conscious of, but the most important one really being that I don't think you can start off with a real knowledge of what it will end up being. You will keep discovering it as you go through the process. When Tony spoke about actuaries being more understanding of profit growth, I could almost sense, in part in the context of the current Indian regulatory environment, where the role of the appointed actuary is very different. I could almost sense a question in Dr. Mamta Suri's mind as to what will it mean from a governance point of view. So I'm going to let her answer that question herself. Because the way I'm seeing it, when we move from a regime which is fairly prescriptive, with clearly drawn lines and boundaries, to one which is much more principles based, and one therefore where different companies, and I'm getting these in questions as well, different companies might choose to use different approaches or basis to reporting. It completely changes the way of oversight from a regulatory point of view. Governance, oversight, comfort on reporting structures may well become a very different model of supervision from what it is today. So just wanted to get your thoughts, ma'am, on how do you see that part of the landscape evolving?
So, thanks, Satyan. So when Tony was saying that, it's the actuary's job to see that the bottom line and the profit, and I was actually looking at him, with a lot of, worries that is it profit coming from the business that is done or is it a created profit? But thankfully, the next line he clarified that you need to create businesses and products which will lead to profit. But yes, the worry is very much there. As a regulator, we are worried that when we talk about a principle-based approach towards reporting of the financial statements and the adoption of the Ind AS for the insurance sector in India, while we appreciate that and we also say that yes, being principle-based, we should not be intervening to give interpretations around, what discount rates and how to interpret particular lines of the standard. But still, when each of the industry players, if they're all going to be doing, an interpretation, it could well result in financial statements which will not be, comparable. And that certainly is a cause of worry. But we do believe that we have faith in our systems. Already I have Kunj here, who's promised me that going back to the Institute of Actuaries, they will discuss matters around, what are things that probably guidances could come around. Those guidances need not be prescriptions, but they could well be nudging towards, certain thought processes which will enable financial statements to be, what they ought to be. The investors need to know how the companies are performing. And even when we are doing that and when moving towards Ind AS, there is also the risk-based capital that is coming in. And certainly the actuaries would be contributing to that. And the two, when both of them are running in tandem, we do believe, that the financial statements which come in finally will result in more transparency, more disclosures, and the investors would know better about the financial statements. But as the other panelists have also pointed out, there would be a need to educate the investors as well on how to read those financial statements. Even me today, when I look at, the financial statements we get on board and what is going to come in through the Ind AS, the difference is so huge. Naturally, we need to, move towards education of not only the people who are going to be laying down the financial statements, but also those who will be, reading them once these are getting published. The other issue around governance that Satyan spoke about, let us also mention about the risk-based supervisory framework that will be coming in. That is another thing that we are working on in the mission mode, to see that the risk-based supervisory framework comes in. So there we also are laying down, the risks that one would be looking at. We are laying down in terms of what would be the significant activities. We are going to be scaling up our own, staff, our officers to see that they also look at the principle-based or, supervision so that we look at what is not just reported, but go beyond that and see that the financial statements and other, risks that are being identified by companies are getting reflected in the right manner to enable the regulator to understand better. But even when we are going to be having the risk-based supervisory framework, we will be interacting with the insurance companies as well. We'll be interacting with their boards. We'll try to understand the risks that they are undertaking and how that particular risk or those particular risks are supported by capital and are also supported by personnel who will be, dealing with those risks. So that broadly is the framework that we will be looking at. And all three of them actually will be rolled out simultaneously. So as a regulator, we know we need to move forward, but I'm sure there will be enough checks and balances to see that we sail through. I'm sure we'll come out tops. Thank you.
Thank you, ma'am. And clearly, even within organizations, we will have to really scale up our own governance mechanisms to ensure that we don't end up in wrong places. I actually want to now take it to you, Phil. And there are some questions also that I'm getting in the context of what are the key things that one has to look for in implementation. So one word, implementation. But underlying that one word is tons of effort. As companies now start, and for a moment before we started this, we were tempted to put up a digital screen with firecrackers going off saying, pro forma January 2025, we have a date, which means we now have to start working on implementation. But we kept the fireworks out of this conversation. So Phil, your thoughts for the people in the audience on the simplest of words, implementation.
Yeah, a lot to unpack there. I think, interestingly, I don't think maybe the others have a similar experience. I don't think I've seen IFRS 17 implemented the same way twice. It seems like everybody's got their own legacy, their own history, their own way of thinking about it. We were talking, an actuary would say it's an actuary project, a finance person would say it's a finance project, and actually sometimes I even get different answers from different people. I mean, I'll talk more about that in a minute, but I think, like you said, the word, if I'm thinking about implementation and I take my kind of actuary hat off for a second, I think we're talking about a project, and we're talking about a long-term project, and we're talking, I think, about a systems implementation project. I think as an actuary, maybe I should be saying this is actuarial and the CSM is just VNB, or maybe as an accountant, I should be saying, this is all financial reporting. But I think if I take that word implementation, to me, I need to be thinking about a long-term 2 or 3 year, IT transformation project, and not the kind of, paradigm shift in insurance value recognition, right? Not a change in the way I look at insurance businesses. Of course, those points are incredibly important, and we will spend a lot of brain power over the next few years thinking about what our contract boundaries are, our coverage units, our discount rates, our illiquidity premiums, hundreds of different topics. But I think what the sort of, meat and potatoes, as I might say in England, of the project is going to be is really about getting, thinking about it as a project that is long-term, that can go wrong, that is going to have pitfalls, that needs managing, and thinking about it as a systems implementation project. I think, and companies really need to kind of take ownership of that very, very early on. It can feel daunting because you say, how can I implement something I have no idea about? But I think realizing that it's a project and that you'll need knowledge partners, that you'll need knowledge internally, and just start project planning and start moving. I think that's one of the really, really key things I would say. And as I said, I think recognizing that the majority of the manpower and probably even spend is going to be around systems is something that needs to be really, really in focus. So our IT colleagues, I'll try and put one up for them. But I think maybe something that they might be more worried about is what I would say, and I think Satyan touched on this a little bit earlier, is about maybe I would say it's kind of like move fast and break things a little bit. I would say get started and get moving. I think a lot of the talk it can get very abstract and very theoretical, but when there's a deadline and you have to take a decision, I would say that really focuses the mind. And I would say I would say start taking those decisions, because when you can see things practically, when you're seeing numbers, when you're able to show those numbers to management and watch their eyebrows raise, it really starts making it real, and then it gets the mind focused to the project and the implementation. And I think we will make mistakes, but maybe we won't make as many mistakes as we think. Hopefully we can leverage some of that global implementation. Hopefully we won't make all the same mistakes that some other companies made. But in those mistakes is the learning process. I don't think you're going to avoid making mistakes or revisiting decisions. Hopefully some of those decisions won't take so much time to revisit. Discount rates is a huge issue, but you can also think about it just as a parameter input. And maybe I can even be changing discount rates 3 months before, 6 months before, 9 months before. I don't know what that date is, but maybe, is it on my critical path? Is it really a decision I need to be making right now? Or can I start moving forward and get some numbers and start bringing it to life? I think it will, the project becomes so, the decisions, the projects, the issues become so much more powerful when you're looking at some numbers. And I certainly can't prepare a draft IFRS 17 balance sheet for anybody in this room in like 2 months' time. And we're not going to sort of slowly trend towards that final balance sheet. I think that balance sheet will jump all over the place as we move forward, and there's a learning process to go through on that. And I definitely know that the kind of presentations I was making in 2017 and 2018, either I missed some key nuance or I was just outright wrong in what I was saying. And maybe, I don't know if everybody else would admit to that, but certainly I know I was wrong on lots of issues. And it's only when you actually build a model, look at a number, check the results, start joining the dots, and start seeing that you're actually going to be able to kind of really move it forward. And I think that probably kind of speaks back to the original point I was making, which is that, just get people on the project and get them learning. I think that's really there. I guess the only other piece I would probably mention, and I'm sure the rest of the panel have lots of points on implementation, but don't forget the BAU. Don't forget the new normal. Don't forget the fact that, okay, I've implemented IFRS 17, I'll sigh a breath of relief and now I'm okay. And then somebody comes and says, cool, let's do our 5-year business plan, right? And all of a sudden you realize that your system can do historical reporting, but it can't do any projection, right? And so take decisions during the project that even if maybe it takes a bit more time or it looks like not necessarily an overkill, but it maybe looks a bit more ideal, think about where it can benefit you down the road so that you're not implementing now, re-implementing 1 year later, re-implementing 2 years after that. And I think there's lots of interesting experiences from global projects where that's potentially happened, where you had to go back a long way because we didn't think a little bit more holistically and with the end in mind, and we maybe took too many shortcuts and things like that. But yeah, definitely it's, I would say for me, it's with a mission mode, with a glide path, I'm thinking with my systems hat on right now, and maybe I'm debating, contract boundaries later. Yeah.
Thanks, Will. Key takeaways for me is implementation is not about the single dimension of actuarial thought processes. It is also substantially about systems and other capabilities as well. And you also spoke about decisions having to be made, and you threw a lot of terms, contract boundaries, discount rates, and so on and so forth. So now I'm going to the go-to person, the man who's done it all, again to him, that in this entire implementation, there is this taking decisions about each of these dimensions. And how should we frame our work in this area? How should we frame our thought processes even as we look at taking decisions? Will they be static? Will they be dynamic? I think that will be very helpful for the audience, because we make decisions in actuarial reporting. Normally, we don't change it very often. It's done. But this may well be a different ball game altogether. Tony?
Okay, initially I planned to cover quite a number of topics, but because of this question, which was rephrased in a different way, I think I should just focus on the most interesting one, which probably affects the most people in this room here, the yield curves, right? How we make the decision on yield curves, because that's quite fundamental to how you derive the IFRS 17 liabilities. Okay. Obviously, the IFRS 17 standard allows two different approaches, a bottom-up approach and a top-down approach. Both these approaches don't come to the same answer, not necessarily the same answer. Okay? I won't explain why, but I'm sure there are enough people in the consulting world to explain this to you. One thing we had to do was to do a lot of study on yield curves. Like AIA operates in 18 countries, but the major ones are about 7 or 8 countries. So we had to go down to all these 7 or 8 countries, and even eventually we expanded even to the smaller countries like Vietnam or Myanmar to see the yield curves down there. Because we were worried. We were worried that changes to the yield curve between reporting periods would lead to unintended fluctuations, volatility in the profits. And also, we had a lot of our products, we did testing on the products to make sure you need to group your products in profitability buckets. Onerous, not onerous, or coming to be onerous, and the third bucket, which is very, very safe. So if you have products in the not so onerous section, but because of a yield curve change could become onerous, we need to understand how to explain this in the disclosures, because it's required, it will be seen. Why last quarter you had this bunch of products in not onerous, suddenly that thing ballooned in this quarter. So these are questions that in our mind we had to run through and do a lot of scenarios to make sure all our countries effectively understood this as well. Then if we go down to a lower level of the yield curves, we found that yield curves behave in a very erratic way from quarter to quarter. You have twists, you have inversions, you have the what do you call by the premium above risk-free, illiquidity premium, also behaving in a very odd way between tenors. So it's not intuitive at all, and it caused a lot of volatility to the accounts. So again, we had to decide whether or not do we adjust for it, which is very difficult, not easy to adjust for such things because it's market consistent, or do we find a framework that allows these things to be self-adjusting over time? Okay, so those are auditions we had to go through. So that piece of work on yield curves, initially we had a working assumption, quite easy one. We had to rework it at least 3 or 4 times. The team there had to go through many more iterations, go back more in the history to find out what's happening and see whether it will come again. So I think that's probably my advice. Do extensive tests across as many reporting cycles as much as possible. For India, I must admit we didn't do all these tests for the Indian market, not because of we didn't want to ignore India, but AIA, I mean, our ownership here is JV, so we don't have to do full consolidated accounts. So it's just a top-line console, not the full up. So luckily we didn't go through this, but I think the Indian team will now have to face these problems. Yeah, and I'm glad that eventually there will be some discussions with the Institute of Actuaries India to harmonize the IFRS 17, perhaps with the RBC yield curves, because that will be the other issue that will come through very, very fast. Yeah.
Thanks, Tony. Again, taking it one step further, and I'm also reflecting some of the questions that I'm getting from the audience. We have certain KPIs that we manage our companies to today. And we have a wide range of stakeholders out there who are looking at what we are presenting as the current KPIs. It could be top-line related metrics, it could be embedded value related metrics, at times it could be profit related metrics or otherwise. Kailash, question for you. How do you see this emerging in the IFRS world? How will we reframe our metrics? Will embedded value still be relevant is a question that I've got from the audience. But you might want to pick that up and generally talk through some of the stakeholders' views or expectations of what companies publish. And once you've done that again, when it comes to stakeholders, it is also about publishing statements which have been reviewed by an independent entity, which means an audit or a review process. And how do you see that emerging? Because particularly in the context of our regime today, actuarial liabilities are the domain of the appointed actuary. While they are peer reviewed and there are governance mechanisms around it, there is no specific audit of the actuarial numbers as they stand today. So these are the two questions I wanted to get your thoughts on.
Sure. Thanks, Satyan. Two lengthy ones. I'll try and be brief on both of them. From a stakeholders, one point is very clear, and this is something that I've had, and it's on a lighter note. There is no function that will not get impacted once an Ind AS migration happens in an insurance company. The only function that you could probably say stays out of it is the admin and the pantry boys. From actuarial to finance, to investments, to HR, to strategy, to sales, products, marketing, anything and everything will get impacted. Investor communications, corporate communications, everyone will fall under the purview. So come to think of it, this is the list of stakeholders that one has to go out and try and manage and influence and tag along and work as one large team. The point that a couple of fellow panelists made, right? All of us have to work jointly sitting across the table. It's not as if I work in a silo in actuarial and in an accounting someone else works on it. The answer is no. This is the list of stakeholders that we got to manage, right? Whether embedded value reporting continues, doesn't continue, again a different flip to it, and maybe just taking a pause. This is an accounting standard. As an entity, as an individual, I am neither creating nor destroying value. Cash in bank is the motherhood of all value created in an insurance contract. I am just reporting it in a particular fashion, whether that is an embedded value construct, an Indian GAAP construct from a P&L balance sheet standpoint, whether it's an Ind AS/IFRS. Value generated is sacrosanct cash in bank at the end of the contract. So value generated is going to be same. Whether one talks about a VNB and embedded value, or say a proxy as a CSM in say an Ind AS world as Phil alluded to, right? Or we talk about the liabilities, that's different accounting wrappers thrown on top of it, right? As long as one is able to demonstrate that, look, in an embedded value world, you would focus on VNB, you would focus on analysis of movement, you would focus on expense overruns or your analysis of variance and the embedded value. One would have to have a corresponding communique going out to the investors, to the board, management, everyone, to say that, look, this is how one looks at cash or potential cash or value being generated when it comes to an Ind AS transition. Elements to watch out for are CSM at initial recognition, and then how does that walk migrate, how does that emanate or drip feed to the P&L quarter on quarter, year on year, what are the drivers, what are the elements to watch out for, what are the variances one looks at, the analysis of change, the assumptions, and so on and so forth. So that's how I would look at it, right? Would embedded value continue to be the talk of the town? Probably yes, because that is something that we as an industry have educated, have spent a lot of time with the investors, with the street, with the market. It'll be difficult for them to suddenly switch it off and migrate to something else. I think that's a bridge that one will have to develop. And if we were to do a scouting around what the global players are doing, from November, December, Jan, as late as February, a lot of them have started indicating what is happening to shareholder equity, what are the few decisions, calls they've taken, what does their new balance sheet look like, and so on and so forth, right? While full set of disclosures will only be out once the quarter one disclosures are in public domain, which would be somewhere, say, end April or maybe early May. But indicative numbers from an impact on shareholder equity, what is the CSM release pattern? Is it an 8%, 10%? Those numbers have started being talked about, right? So that bridge is being created in the investor's mind, that those talking points have started getting shared, right? So that's how I would look at the stakeholder point. If I were to maybe, stretch that argument and say that, okay, this is all internal, this is all value, but what happens at the regulator's front? What happens from an auditor's standpoint, right? While we've got in-house experts and again, peculiarity in the Indian environment where liabilities are blessed or signed off by the appointed actuary and the auditor gets a carve-out report or an appointed actuary certificate and doesn't delve into it deeper, unlike other jurisdictions where the audit firms have to sign off the complete balance sheet and not just half the balance sheet, right? I would say that it's only a matter of time. Obviously, capacity constraints, understanding philosophies, mindsets, and alignment. But eventually, there will have to be one person who's responsible for the financial statements. There has to be one person who puts his or her neck on the line and says, I have looked at it, I am the signing partner, and these are fair and reasonable set of financial statements, right? Tickling a funny bone, that is the person who will go to jail if anything goes wrong, right? So if you've got someone's neck on the line, someone who's willing to go to jail because the financial statements are incorrect, then you've got to have one neck to catch, and then that's how one looks at it, right? But yeah, obviously it's a transition, right? Ma'am talked about, say, Jan 25, give or take a month here or there. And we as stakeholders, as actuaries in the room, finance professionals in the room, key management personnel in the room, we've got, say, work carved out for the next 24 odd months or 22, 24 odd months ahead of us. And this is something that we've got to work towards. That's how I would look at it.
Thanks, Kailash. So I'll go over to Kunj for one final main conversation questions before I start picking up some of the audience questions as well. And like Kailash spoke about, we have now started seeing at least some European companies disclose preliminary results. If you could share with the group as to what are you seeing as trends, what are you seeing as the key elements that are coming out? And one step beyond that, given your involvement in the actuarial profession, again, in the context of going from here, what do you see as the role of the institute and the profession in this entire space of IFRS?
Right. So there are two questions in there, and I'll address both of them a little independent of each other. So there are about almost 33, 35 odd insurers who have provided their indicative impacts on IFRS 17. There are two categories of takeaways: what changes and what does not change, and where things do change, why. So almost these are the three critical areas to look at. The easy one is what does not change, and almost universally, as far as I'm seeing, almost universally, most of the investor presentations that have come out have emphasized that the core business operating model, the dividend paying capacity, the solvency levels, do we need a capital injection because we have moved to an IFRS 17, or can we continue to distribute capital the way we are currently? Those metrics by and large remain unchanged. What does change, in some cases very materially, and in some cases not very materially, has been the opening equity position on the balance sheet itself. So the assets and liabilities, the net position is being the net equity. You have a fairly mixed bag here. So what Tony mentioned was, in AIA, they wanted to kind of get it as close as possible because of constraints. We've seen that also in many other European large multinational cases where some of the CFOs, global CFOs, have even gone on record to say that it wasn't a coincidental outcome. It was actually a designed outcome where we did not want a large transition impact on equity, and therefore the transition choices we've made have ensured that by and large the transition levels remain very similar. Now that's been the case for a certain subset of the companies. Equally, you've got fairly material impacts for particularly long-term annuity providers where, and fundamentally the insurance accounting today have two very clear spectrums. One is an economic basis of insurance accounting, which permits you to take credit of your future cash flows, future incomes, future premiums, discount them all back, and allows you to take credit of that on today's reported numbers. Now that would be an example of an IEV framework. That would be an example of, you know, any market consistent, so to say, market consistent framework without any zeroization of negative values and so on and so forth, such as Solvency II or even many of the reporting standards in Europe. At the other end, you have a very cash-driven accounting basis, which is you recognize cash when you receive it. You recognize outgo as soon as you incur it. Doesn't matter whether it's an expense you've incurred over for an acquisition of a contract, you recognize the entirety of it. And then you also recognize, let's say, the provisioning you've created, which is the kind of framework we have in India. Now, IFRS 17 sits somewhere in between of that. It starts with an economic model, but it is not purely an economic model because it takes that economics of the contract and parks it in what is called a CSM and then recognizes it over time. So it sort of becomes a little bit of a hybrid model, and that's why what happens when we are speaking at the disclosures is depending from where you're going to where, the journey is slightly different. So if you're going from a pure economic model to an IFRS 17 model, or a pure accounting deferrals and matching model to an IFRS 17 model, that impact is slightly different because your starting point is different. And that is a material shift, and what we need to be aware of in India is benchmarks do help, but they, as much as they help, they can also hinder. Because if you're comparing a company who's going from an economic basis to an IFRS 17 basis and saying, okay, my equity has reduced, and you make a statement that we might expect IFRS 17 equity to reduce, that may or may not be the case when you're going from the other side. So that's one learning also. The other learning is IFRS 17 disclosures are not only about IFRS 17. Because we need to create, and very early in the program we should have that line of sight now with that learning, is we need to create, either you call it the waterfalls or the reconciliation, but really there'll be several of those. There will be a reconciliation from your current GAAP profits to an IFRS 17 profit, how that earning is different. There will need to be a reconciliation when RBC comes in. There are common components of an RBC liability and asset valuation to an IFRS 17 and 9 value of liability and valuation of assets. What the waterfall there is. From IEV, which is already being relied upon by a lot of investors, not just for listed companies, but also for quasi-listed companies where their parent group might have exposure to the equity markets. You need reconciliations from IEV. Now that is also a disclosure that has started to emerge, or commentary around that has started to emerge. What are those reconciliation steps and how that works out? So inbuilt in IFRS 17, inbuilt in our AOM and IEV movement analysis is period to period movement, right? So you say, my opening number was this, my closing number is this. Here you have a different dimension of movement. Your opening number was X and closing number is Y. You definitely have to create that bridge, which we are creating. But at the same time, within the closing number, we also have to, from each metric to each metric, create those new bridges. So that's an interesting dimension also that is coming through. How institute, and I'm conscious of the ticker that's in front of us, and therefore I want to move to the next one in terms of how the Institute of Actuaries can support, and I'll sort of drop my technical actuarial hat and wear a completely different, advisory group hat there. There are several things that we have in the works, and that will require both a community participation as well as initiative driven from the Institute. And here are a few of the things, as Ms. Suri also mentioned. One thing that we will definitely want to take a lead on is provide guidance of sorts, or a framework that people can refer to, where it is a principle-based standard. As Tony mentioned, you had to go away and do analysis of the yield curves in 18 countries. But hopefully 18 insurance companies don't have to do the same analysis for one country. So hopefully we can take that burden within the institute, that if there are 18 companies who have to do the analysis of one country, then at least a central professional body can take that on, provide the outcomes and results, and of course it's people to accept it, reject it, at least deliberate it. So that's one of the ways definitely we would like to support. One of the things we have already started is collaboration, and that's one of proud things. Satyan, your first question was the actuaries and the finance people and the IT people need to come together. Yes, in the insurance company, but also as a professional association and professional body. So what we are very proud of, that we are collaborating very closely with the Institute of Chartered Accountants already. We are doing joint industry training programs with the ICICI and II together for both actuaries and finance people in the same room. So the faculty and the people in the room, they're all common. That collaboration is ongoing, and we would continue to do more of that and require everybody's support. And the third critical component, which we have started in the GI space, if Anurag is here, he's been really helpful in driving that as well, where we are bringing together practitioners on common topics of interest to do a round table conversation. The output of that conversation is learnings. That's it. The output of that conversation is not that we will go away and publish a white paper or publish a practice standard or publish a guidance note or anything of the sort. The output is exchange ideas, exchange learnings, and get to know what everybody is thinking. And we would like to create more and more of those forums within the institute body, so that people can come together, discuss, deliberate. There would be a person transcribing notes and publish notes at the end of it, and they're just in the form of notes, really. We've done that already, as I said, for a topic on general insurance. We can extend that to IFRS 17. We hope to do that, and that on its own will lead to a lot of cross-pollination of ideas. So 3 initiatives underway. Hopefully that will assist everybody. The institute only exists to help each other. So if something doesn't work, it's easy to stop. And if something works, it's easy to do more of. And that's where we are.
I think that's a very powerful way to end it, Kunj. I think it's up to us now to engage with the professional body and with each other to see how best we can further it. On that note, I'm going to go into rapid fire with a few minutes left on the clock and some questions that I have on Slido. So very quickly, ma'am, first question for you. Do we expect specific guidance from the regulator on the standard, or do we expect it to remain a principles-based with other stakeholders giving?
I think I have already answered that, Satyan. For us, as we see it today, it is going to be a principle-based standard. But then I have my various arms, the II, the ICI, the councils, all of them can support in terms of guidance. We do appreciate that the guidance is required. But as of today, we believe it's a principle-based implementation, please.
One for you, Tony. You have done it in a particular way for AIA as a group. If you were to do it for the India business from scratch, can they reuse some of your learnings? Will their journey be shorter than what it was for you?
Okay, I did mention during lunch the biggest challenge I see for local Indian, for AIA in India is the data side, because we can't just cut and paste the system that we've developed into India. We have to make sure all the data definitions here on the actual side from the admin system can feed into the sub-ledgers that's been built for the group. So that's probably one of the hardest pieces of job that needs to be done. Financials shouldn't be too difficult. Just need to understand the Indian gap today, see whether what should be the best transition strategy. I think that's the short answer.
Thanks, Tony. Quick one for you, Kailash. Couple of things from an audit point of view. You go through implementation and then suddenly you find that your auditor has a different point of view on the same matter. Or in a fully audited actuarial work, the expectation of level of documentation becomes a very different one. Quick thoughts on these.
No, absolutely, Satyan. These are two potential pain points. So one thing that I would probably just spend a minute on, SAMA, which is the Saudi Arabian Monetary Authority or the Saudi Central Bank, and these guys have done it beautifully, right? Worked like clockwork as a regulator across the industry for over the last 2 years, and they forced the industry to actually go through 3 dry runs. The third dry run is underway, right? And what did the first dry run do? The first dry run said, fix up your opening balance sheet, get your auditor to review it and submit comments to the audit committee. Dry run 2, do it for a Q1 or H1 of the comparative set of financial statements, get it reviewed by the audit committee. They put us as potential auditors in a spot to provide a management rep letter, provide a submission to the audit committee as if we were signing off an audit opinion. That was the rigor that went into it, right? And this was pretty much mandated. SOCPA, which is the ICICI equivalent, the institute, actual body, and the regulator, which is SCB or SAMA, all 3 came together and said, we will work like clockwork on this. Beautifully executed. Obviously, it spilled over because of time constraints and stuff. Dry run 3 was supposed to wrap up in Jan. It's still underway as we are in March. So that's one. From a documentation standpoint, the earlier we get something penciled in is better. And I think we as panelists spoke about it as well, right? The very fact that, look, it's a principles-based standard, there is a shade of gray that we will have to pick on. It's not black and white. The shade of gray, whatever it be, pen it down. Even if it's a scribble note, even if it's a piece of paper, a half a page document, pen it down, put it in the file. Build up on it as you move along. Do not try and complete the entire exercise on day 1 and say, I will do everything for the full book and generate my final number, and that will be the first time I'll report. Move as you move ahead. Look at the book. Look at, say, half the book, 1/3 of the book, 2/3 of the book, whatever it be. Start experimenting. Start getting a feel of the full balance sheet, full P&L. That helps stakeholders, that helps management, that helps the board, and also in turn the auditors.
On a lighter note on your documentation point, in other words, what Kailash is saying is he'll be very happy to take scribbles in a file when he comes along.
I'll be more than happy
I
to
wish.
see some scribbles.
I say this as an auditee, I wish. There are some technically oriented questions which I would encourage you to chat up with the panelists on over coffee. So I just want to conclude with one last question. Phil, to you. Is this likely to change product mix of companies, business strategies, pricing strategies? Quick thoughts.
So yeah, you're not going to get me to take a call here. I think fundamentally, I think we all agree it's a reporting standard, and so if you're doing the right business, carry on doing the right business. It may report differently, but if you engage with your stakeholders and explain it to them and say, look, we've got a strategy, we've got a track record, it's working, no reason to change anything. Maybe you'll see this as onerous, but I'm going to explain to you that it's a kind of composite strategy, or it's a new area I'm going into, or something like that. But I guess one thing a CFO said to me, and I don't know whether this resonates with you, is eventually accounting does drive activity, right? Eventually, if you keep reporting the numbers in a certain way, that's going to sort of change the mindset of the organization. And so, we'll see. I mean, there's going to be changes in product mix in the industry for sure. Is it going to be driven by IFRS? Is it going to accelerate things? Is it going to slow things down? Maybe, but I think it maybe will be different for different entities as well. Especially, some of the insurance groups, they've been running their business for 150 years, right? They know what creates value. They know what doesn't create value. And just by using some new accounting methodology, they may not change that at all. But I certainly think it's going to change that frame of reference of how we look at products. And hopefully, maybe for the better. Let's hope. Yeah.
Thanks, Phil. Nearly 4 minutes, about time. Sorry about that. But it's been a pleasure for me to be in conversation with all of you. Yesterday during ACFA, somebody spoke about being blinded by the lights from there. I'm getting blinded by the talent on stage. Thank you so much.
Thank you all. I think it indeed was a very interactive conversation and a lot of takeaways for us in terms of collaborative efforts across actuarial, finance, and IT teams, and of course, various arms for IRD coming, IAI, ICICI, looking forward to the support. So very, very encouraging and very interactive. Thank you all. I would request, I would request Mr. Jambunathan to please hand over a token of present from our side to Mr. Cheong, or I should say Tony. A small token to Miss Suri. A token for Kunj. A token for Philip. And a token for Kailash. Picture together. I would like to call Mr. Karunanidhi to give a vote of present to Mr. Satyan Jambunathan. We'll have a picture. Thank you all.